Hello, guys. So, what I'm going to share with you is helpful to both beginners and people that have been trading for a very long time. It's just an extract of my complete trader course. So, feel free to sit down and listen. I want you to get rid of any distractions and listen very carefully to what I'm about to say because it's going to be very important in your trading journey. It's going to let you know some of the things that you couldn't explain that happen in the market that many textbooks don't really tell you, that the internet doesn't really explain. So I'm here to just dish out this information for you guys so that your trading may be much, much simpler and you would understand why certain movements happen in the market. All right. So this today that I'm going to share with you, I'm going to term it the cash cycle. All right. And it's going to explain movements around certain currencies, certain indices, gold and oil. And the major reason why I had to make this video is because a lot of traders out there don't know the relationship between certain pairs and the indices and the metals and the cryptos. And the reason is most people focus on just studying that one particular currency or that one particular asset in terms of technical analysis, and they don't really understand what is causing the price movement of that particular thing. And therefore, sometimes you are shocked in the market as to why is gold moving in a particular direction, or why is both gold and oil going the same direction, and why is things that you would not normally expect to happen, and then they are happening. So this video here is going to clarify most of this stuff for you. And I'm also going to mention, some of the news releases that you should watch out for particular pairs. So this is going to be a very informative episode, guys. So I would urge you to just take a look at this video. Um, Maybe it helps you, maybe it doesn't. I don't know, but I'm really hoping that your trading journey is going to be much better after this video. All right, so let's talk about cash in general. Now, if you have any idea at all about money, right, you would understand that you hold on to money when it has value to you. You cannot hold on to money or you cannot put money in a bank when there is no value in having the money with you. All right. You actually need to make your money work for you. Therefore, you invest in something. But when those investments don't look like they are worth you actually investing in, you hold on to your cash. So during situations where there is low inflation and there is no growth prospect in stocks, and there is low interest rates, that is to say, it is actually cheaper to borrow cash, you will find that people will hold on to cash during these times. So you have the cash safe havens that you have on the forex market, actually USD Swiss franc, which is almost a 1:1 um, rate, and USD JPY. Those are the two cash safe havens that you have within the forex trading spaces, because also with the Japanese yen, you have a very stable country and very industrious country. And therefore, we have trade relations between the US and Japan influencing that safe haven nature um, of the USD JPY. So USD JPY and USD Swiss franc are your safe havens. And whenever a person is to, or an investor, or whether it's an institutional investor or a, an individual investor, are to have cash, they are going to hold it in terms of either the USD, converting it back and forth with the Swiss franc or the JPY. So USD JPY is when there is low inflation, you expect them to rise. You expect USD Swiss franc to rise. When there's low interest rates, you expect also USD Swiss franc and USD JPY to be rising, right? And I wrote here that this is just the middle ground of all transaction. Of course, for every transaction that you want to do, you need to have cash. You can't straight away change from gold to oil. You would have to sell your gold into cash and then get oil. So you will find there are times when, say, there is an event, major economic event, and you have a massive spike in the USD Swiss franc, and then it falls back down. It just simply means there is a transition that's going on. People are selling, let's say, gold, right? And then buying stocks. So you have a massive spike in cash, and then you have a spike that is a much more delayed spike in stocks, right? Because people are actually converting from gold into cash, then to stocks. All right. So we have the first movement that we expect to happen is the movement between cash into stocks, because that's the first natural investment that people make. All right. So stocks are pretty much risky assets, right? So if people feel good about the economy, if people feel good about the prospects of growth within certain industries and all of that, they will not hold on to their cash, but actually put money into stocks. So the generic theory here is companies are a going concern, right? We expect growth in companies in the long run. So in the long run, stocks continue going up. That's why you see the Nasdaq has always been going up. You see the US 30, S&P 500. If you look at the long-term scale of things, these have always been on the uptick, right? And this is because you cannot hold on to cash as there is always inflation looming, right? You can't always hold on to cash. If you look at a dollar 20 years ago and the dollar today will not afford as much as a dollar 20 years ago could afford. And therefore, people would actually put their money into stocks. So if the stock market is outperforming the inflation rate, then people will move their money into stocks, right? So if there's good employment data, that is NFP and all of this, that's why I put it out there, just NFP and all good employment data, depending on the country, good earnings reports from the company. So I put Apple and Meta there because most of the tech companies at this stage are the ones that are dominating the space, and therefore, if you have got good earnings reports from Apple, Meta, Google, and all of these. And right now we are on the verge of AI, so I'm pretty sure that very soon AI companies would be added onto the Nasdaq index. So we'll remove a couple of outdated companies from the US 100 and then put on a couple of AI companies there. All right. And then when there's general risk affinity, or there's a bit risk sentiment. All right. So people are actually looking at, okay, I think things are looking good. I can give you an example. Just after COVID, right? Or I wouldn't say after COVID, I would say just after the vaccine was introduced, you had people feeling much better about the prospects of the globe, all right? The prospects of the future. So you have people taking out money and investing in stocks. So you find stock prices rising again after the the incidence of the vaccine, right? And then when you have a moderate inflation, the reason why I put moderate there is obviously inflation is going to be increasing with time. But then if the stock market is outperforming the inflation rate, then it means there is prospect for growth in the stocks. It's sort of no use to hold on to your money if you see that the inflation rate is, yes, it's low, but there is a better earning potential if you put your money in stocks. You would rather put your money in stocks so that you could um, outdo the risk of the inflation, right? So you have NASDAQ, US 30, S&P 500 being at the fore of the stocks game. And I want to also mention now that because of the nature of trade that is between the US and Japan and the tech companies in Japan, you will find out that most of the times when, say, I'm just giving an example, say there is a good announcement on Apple and all of these, you'll find US 30 uh, NASDAQ going up the same time as USD JPY. So you don't see here an inverse relationship going on. You actually see them going in the same direction because USD JPY represents the stock market as well. So if there is news that is good for cash, USD JPY will go up. If there is news that is good for stocks, USD Swiss franc will go down while USD JPY is going up. So this is some of the points that people get confused with and trying to understand why is this one going up and why is this one going down. I know this video is quite long, but bear with me. I'm trying to explain some phenomenon that a lot of traders don't actually get to understand. And now I want to mention Euro USD, GBP USD, and Bitcoin USD. When there is a good feeling out there, remember, because of how the Eurozone is structured, right? There is a lot of risk sentiment around the Eurozone because remember, you have the pound and the euro operating within the same area. And these, of course, go in almost typically the same direction because they're operating within the same region. However, because of the uh, trade tensions that may happen here and there with the Eurozone and the US, you have a slight risk sentiment attached to the euro and attached to the pound. And this is the reason why when the euro USD are going up, USD Swiss franc is going down. It's because people are actually taking out money from the safe haven, which is the Swiss franc and the US, and they are putting it in the Eurozone, which is not as safe as the Swiss franc or JPY. So you find that majority of the time, when the economy or the data of the economy is good for stocks, and then also risky cash, which is Euro USD and GBP USD, actually benefits from that, and even Bitcoin and all of the other cryptos, all right? So this is one thing to take note of as well. Now, money then moves either from cash into stocks, or if there is a high inflationary rate, it will move either into oil and gold, both. So when there is a very high inflation, you will find oil and gold going in the same direction. And why is this? So I'm going to explain this in a very small instance. When there is high inflation, we expect, well, it depends on on how you look at it. I'm going to cite here the false cause in economics. It could be oil that causes inflation, or it could be inflation that causes a change in the price of oil. It is actually the ergo propter hoc fallacy in economics, right? So you have or the post hoc fallacy in economics. You have oil that is pretty much the basis of inflation, right? The general inflation is defined as the general persistent rise in price of basic commodities, right? And oil is at the foundation of it all. Because for us to produce basic commodities, we need oil, right? Now, if we have a challenge in extracting oil or we have issues to do with oil, you will have a hyperinflationary environment. But then a hyperinflationary environment means the price of oil is going to go up. And if the price of oil, so if we expect there to be a high inflation or a hyperinflationary environment, people will move their money into oil because they know that oil is going to go up. But at some stage, the hyperinflation is too much to the point where we need to take our money from oil and put it into gold, which is a safer haven, because the price of oil can go down dramatically in a split second, just like that. And why is that? Because of geopolitical tensions. You could have a war that is erupted. You could have Russia and Ukraine, and then the US is putting sanctions on this particular country that has oil. So the price of oil could either go up or down depending on how this actually affects the inventories of the oil. So if you have companies that pretty much deal in oil um, performing well, then the oil price is probably going to go up. Right? So you have the stocks here as the second option from the cash. And then when a person feels like, okay, I can take more risk, probably, they will convert their money from the stocks into oil. Right? But then at that point, you have people taking risks and not actually migrating to safe havens. But then when there is an event, probably more hyperinflationary than what is sustainable for an oil investment, for example, COVID, right? You will have people convert straight from oil uh, back to cash and then to gold, which is the fourth item on this list. And gold represents the safe haven of all havens, all right? If you look at the chart for gold, it has ever been going up. Of course, there is slight dips here and there, but the price of gold is always going up in the long run. And this is because gold is the safe haven, ever has been, ever will be, right? You look at times before time, gold has always been the safe haven. So when cash fails, when stocks fail, when oil fails, when all else fails, people put money into gold. So you have got gold as a safe haven during hyperinflationary times, during wars, during global crises like COVID, during famines and all of that. People will put money in gold. And then when there is a now better outlook, right, later on, for example, after COVID, right, you have people taking their money back from gold into cash, which explains the inverse relationship between XAU USD, that is gold, and USD JPY or USD Swiss franc, right? It explains the reason why these charts are going opposite each other. The same way, uh, you know, with the US 30, NASDAQ, and all of that, gold is actually going in the opposite direction with those because these represent um, good times and this represents bad times. So in terms of analysis or analyzing charts, you could analyze the chart of USD to trade gold. And that is very, very possible. During times when you have straight up hyperinflationary environments, USD JPY is going down and gold price is going up, right? And then you have when times when there is good GDP announcements, right, and also good earnings reports or good employment data, you have NASDAQ, US 30, S&P 500 going up. And this also means that people are actually taking away from the cash, means gold is going down. Yeah, so this cash cycle, I may not be able to exhaust everything. I don't want the video to be too long. I do explain some of this in my one-on-one course with my students. But if you want to understand these currencies, if you want to understand these indices, you have to dig deeper than just the chart, right? Some people, ask questions like, okay, so why do I wake up? There is a gap in the market. Say, I wake up on a Monday, right? And there is a gap in the market. We call this slippage, right? Where there is a former price, let's say gold was trading at 2100, and then the following morning starts trading at 2200. And that jump there will ignore take profits, it will ignore stop losses that were in there, in between that gap, and you will find maybe your account has been wiped because of the gap. This gap here represents what we term slippage. And slippage simply means we have sellers in the market that are not willing to accept any price below the price that they are offering at that particular moment. So if the offer price was 2100 yesterday, and then we woke up today and the sellers are not willing to accept any price between 2100 to 2200, they're only willing to accept 2200. Remember that trading is a willing buyer, willing seller scenario. So there is no ask if there is no bid. So you can only exercise your contract at the new ask price. You cannot exercise your contract at the previous ask price, which is 2100. You can only exercise it 2200. So it means that's the only price that the transaction will be concluded. And therefore, the market will ignore your stop losses. It will ignore your take profits from all of those prices. And that gap represents the new price that the sellers are willing to sell whatever it is that they're selling at. I hope this explanation suffices. If it doesn't suffice, feel free to send me a question on my email, which I have put there, which is thecompletetrader@consultant.com. But otherwise, guys, have a lovely trading week, trading month, or trading year. If you like this video, give it a thumbs up, express whatever you want to express in the comment section. Okay, good day.